in the market. We're joined by Dan Geltrude, who's the business analyst and founder of Geltrude and Company. Dan, good to have you back as always to get your insights here on what has been a downward spiral that we've been watching throughout the day, from the futures now into about halfway through the trading session here.
Yeah, it's a tough day today. I mean, we could see with all the red on the board that things are not going in the right direction. So the question is why. There was a lot of discussion related to the inversion on the bond market and what kind of impact that's having. Does that mean that we're heading into a recession?
Sure.
That's where we were in 2007, and for the last 50 years, that's been a key indicator as to where we're going. However, I don't necessarily think that we're going there in spite of everything that we see going on right now. That inversion in the treasuries, let's see how long that lasts. Is that a temporary blip? And even if we were going into a recession, that indicator still is going to put us out 18 to 24 months historically.
Yeah.
So what happened this week and last week? What really pushed the yield curve to invert?
I personally think that what we're seeing in Europe and Japan is we have negative interest rates on their 10-year bonds. So where is money moving? Money is moving into the United States. So you have this flood of money coming into the 10-year treasuries.
Right, they're not going to equities.
Right, absolutely, they're not going to equities. So what's happening is we're bringing down those rates, causing this inversion.
Well, explain how that works. When yields are down, it means the prices of bonds are higher. It signals that investor demand is moving into bonds.
Right, because, well, people are moving into bonds because they're afraid of what's happening right now in the equities, right? So there's a movement to bond, and it's supply and demand. As you have more people moving into bonds, the demand is greater, the rates are simply going to come down. It's that basic.
The greater risk to the markets right now, China, or is it the yield curve simply?
I actually think it's China. We have some significant issues going on with China right now. The obvious one is what's happening with trade. We got some good news, or what appeared to be good news, from the president, where he said, you know what, we're going to push off the tariffs until December. We want to be mindful of our holiday season and make sure no one gets hurt.
Well, some of the items that are on the list that are set to go, that have tariffs set to go on them, including electronics, some products from retailers, but there are still 10% tariffs that are set to go into
Yes,
effect.
it's not on every single product, but what he's trying to do is he's trying to protect retail through the holiday season, which is an interesting thing, right? Because the president has said many times, we are collecting all these tariffs from China. Well, wait a minute. If we're collecting all these tariffs from China, why would you be concerned about what's happening with retail in the United States?
Right.
The truth of the matter is that tariffs are a tax. And who's paying that tax? Consumers. They're paying it ultimately through the companies that are passing along those increases.
Well, how much of the pain that we're seeing in the markets can be attributed to what we are hearing from the White House?
Well, I think it definitely plays a role. There's no question about it. I think the market is not particularly happy with the way things are going with trade. I mean, the fact that Trump backed off a little bit means, hey, maybe this isn't going as well as we thought, and are we really going to get a good deal? Not a deal. I think we could have a deal tomorrow. Yeah. The question is whether we can get a good deal. And I think there's a lot of uncertainty there that the market is paying attention to.
It's not just protectionism between U.S. and China. There are other countries as well that are taking more of an approach of, hey, we want to protect our businesses at this time of turmoil and volatility. And so if you do enter into a protectionist state where countries are simply looking out for themselves, their own businesses, what does that spell out for foreign investment into each other's businesses, into each other's infrastructure, countries? Do you see that shut down, and how does that impact some of the businesses right here in the U.S.?
Well, maybe that's the new way that the world operates. World War III through economics, right? Wow. So we may not be out on the battlefield, but we're out in this economic battlefield. And if everybody is looking to protect their own interests, that is going to lead to, in my opinion, a pullback as to, do we really want to do some foreign investing? If that's going to strengthen the other guy, we want to keep everything at home. But it can't work that way. All economies are really tied to a global economy right now. Hence why we're seeing, I'll go back to the inversion on the bond rates for a moment. Part of the reason that we're seeing that is because of what's going on in the rest of the world. We have negative interest rates in Europe and Japan.
Yeah.
What's happening? The money's flowing into the United States. So we're all interrelated here.
I'm not sure if we can talk about specific names, but I mean, Saudi Aramco's IPO, it seems like there's a ton of demand to get into that. That would go against the protectionist argument, I suppose, in that you'd have a bunch of countries, especially institutions here in the U.S., that would want to get into Saudi Aramco for what it's able to produce on the profit side without investment or putting stock out there for outside investors as well over the years.
Well, that would make you think that
it's 100 years anomaly, maybe.
Well, I mean, you would think that profits trump nationalism, right?
Okay, yeah.
And that's ultimately what it should come down to in a capitalistic market.
But I want to talk Germany. What do you make of Germany's shrinking economy? How are you reading into that and the effect of the U.S.?
I think that Germany's got some real concerns, and part of the reason for that is what's going on with Brexit, right? So you got Boris Johnson, Prime Minister of the UK, is saying we're out by October 31st. Funny that it's Halloween, right? But we're out by October 31st with or without a plan.
That would line up with Boris Johnson's jokes and his history of that. So.
But that spells some real trouble, and that, I think, puts a lot of strain on Germany, who, quite frankly, is carrying the European Union. And when you see that the German economy is shrinking, that's a real concern for Europe. I don't think that could be ignored.
Jobs numbers that we're going to be looking out here for in the future, where do you expect those to come in at? Falling or at least surprising in one way or the other?
Well, I think that we'll probably see the jobs number down from prior month, only because I think we're seeing some real concerns about what's going on in the market. Although I think the economy has really strong fundamentals, you can't ignore what's happening here today and around the world.
And jobs a lagging indicator, too. What are the other data points that you're looking at in terms of what investors should be watching closely?
I think investors need to keep a close eye on what's going on with these treasuries, because if we stay in this inverted yield curve, that's going to spell trouble for equities.
Okay, so just very briefly, what exactly is the story that an inverted yield curve tells? We only have about 15 seconds left.
An inverted yield curve is telling us that borrowing money short term is cheaper than long term, which makes absolutely no sense. It's like going to a bank and getting a 5-year CD, and the interest rate is lower than a 1-year CD. It makes absolutely no sense.
Dan Geltrude, he's business analyst and also the founder of Geltrude & Company. Always great to have you on Cheddar Business. Thank you so much for joining us.